The UK construction market remains uncertain, but there are signs of resilience. Workloads are easing and pipeline gaps are emerging, but steady demand in key segments offer modest grounds for optimism. In this update, I'll cover the macroeconomic outlook. Emma will explore input cost drivers, including materials and labor. Mike will highlight sector trends, and in this film, Chris, from our Newcastle office, reports on how the government's modern industrial strategy is influencing the North East. The UK economy saw strong early year growth, the best in the G7, but momentum has slowed, with GDP now expected to grow by around 1.2% in 2025. Inflation sits at 3.8%, likely peaking at 4% before decreasing gradually. The Bank of England has cut rates to 4%, reducing financial pressures. However, optimism of further interest rate cuts this year look less likely. The construction PMI, a measure of overall activity, rose to 45.5 in August, signaling a further decline, although at a slower pace than reported in July. And construction output grew 1.2% in Q2, driven by backlog delivery, even as new orders fell. Overall, construction activity remains challenging, but opportunities exist. Early engagement and flexible strategies will be key to unlock value.
Material supply is stable and lead times have normalised. Softer demand is helping to keep prices in check. However, overall material prices rose by 1.4% in the first half of 2025, largely due to payroll costs and supply contingencies. Imported goods remain vulnerable to global risks, including tariffs, currency shifts and shipping delays. Making the most of current price stability while planning for volatility in imports will help mitigate risk. Construction vacancies have dropped by 40% since their peak in early 2022. And although wage growth has slowed, this is still well above the rate of inflation. Despite the reduction in job openings, demographic and regularity factors and strong demand for infrastructure mean that labour supply remains structurally constrained. It's important to plan for elevated labour costs and potential resourcing challenges, particularly on complex projects as workloads start to recover.
Momentum varies across sectors. Some are attracting strong investment and policy support, while others remain subdued. Focusing on the most active areas highlights the clearest opportunities in the near term. Commercial activity is focused on prime refurbishments and fit-outs, driven by hybrid working and ESG upgrades. Residential starts are rising slowly, but Gateway 2 delays continue to stall high-rise delivery, stretching project timelines. Healthcare is focused on remediation and retrofit, while life sciences activity continues at a steady pace. Infrastructure is driving growth, supported by a strong investment in energy, utilities and rail. Infrastructure growth, helped by the modern industrial strategy, is turning the North East into a region of opportunity. From Newcastle, Chris Lewis takes up the story.
The UK government has committed billions of pounds through a multi-year plan that identifies 8 growth sectors, and the North East is already at the forefront of some of these sectors. The region has seen heavy investment in the clean energy sectors, such as wind and hydrogen, along with high-tech manufacturing, data centres and large regeneration projects. We're already working with major clients in the region, from National Grid to Northumbrian Water and from Teesside Oil Refinery to Eastern Green Link, which are projects of national importance. That blend of local knowledge and national capability means that we understand both the strategic significance and the real on-the-ground impact of the modern industrial strategy and 10-year infrastructure plan in the North East region.
Here are 5 key takeaways from this quarter's update, along with G&T's recommendations. 1. Workloads are easing and pipeline gaps are emerging. Engage early and phase flexibly to maintain momentum. 2. Investment remains cautious. Allow time for approvals, particularly in the residential sector, and tailor procurement to manage risk and attract interest. 3. Labour costs remain the key inflationary driver. Factor in labour-driven cost pressure and realistic preliminaries for accurate forecasts. 4. Demand remains resilient in certain segments. Focus on active sectors and align delivery strategies to available capacity to strengthen pipelines. 5. Regions most affected by historical industrial decline are the focus of modern infrastructure and skills initiatives and could offer significant potential for investment. We recommend getting in touch with us to plan early, manage risk, and shape your project clearly to stand out in a cautious and competitive market.